You've been selling stocks, buying bonds. Why?
So I should say we still believe in the role of stocks in the long run, but to quote Powell, headwinds have become tailwinds. But I would add, keeping to the aircraft analogy, that we're entering a period of turbulence. Volatility has spiked, and this rarely happens in isolation. It tends to stick around in the markets. So we are in a higher turbulence environment. Will we get paid to take risk this year? Look, 8 out of the last 8 times that we've seen a Fed hike cycle, PEs have declined in history. Now, this time could be different because, first of all, we're still in easing mode. We're not tightening yet. And also, you have this unusual timing for fiscal stimulus. And sentiment is very good. So this time might be slightly different. But nonetheless, history is on the side of having elevated volatility, meaning, we might not get paid as much for risk assets. So we are on the margin taking away from equities. We're adding to both bonds and cash.
So where would you be buying in treasuries? Where do you feel is safe?
So in treasuries, we are somewhat neutral in terms of duration. So we think, at this point, it's unlikely that the 10-year will stay elevated above 3%. And the interesting thing is that on the front end of the curve, in the cash markets, you now earn about 1.6% on cash. And by the end of the year, you'll earn 2%. So the third asset class is back, right? Stocks, bonds, and cash. Now, cash is the ultimate diversifier where you get interest rate shocks. Interest rate shocks lead to higher stock-bond correlation. And their treasuries don't diversify stocks as well.